Hi traders, welcome to this edition of Expert Market Analysis, brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I'll just let you have a quick look at the two disclaimers, I'll just run through some of the key objectives of the webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. So yes, I'm just letting you get through those disclaimers, which I'm sure you've checked out. Our goal is to break down all the market jargon and complexities that you read about. So if you do have any questions, please do ask them along the way, and we'll try and answer those if I see them in the box. Otherwise, we'll answer them at the end of the webinar. Okay, it's Wednesday. It's September the 10th, just after 11 a.m. in London. So let's get to it. We'll just check out firstly the markets, how they're trading currently. Then we'll go through a couple of themes, political themes really, in Japan and France. We'll look at equities as well. Before then, just a quick review of the main events from last week. Non-farm payroll, of course. We also had some Eurozone inflation data. And then we'll look at this week's main events, mainly on Thursday, tomorrow actually. So we have, of course, the ECB meeting and also the US CPI data. So we'll look at that and a quick preview of that ahead, of course, of the Fed meeting next week. Firstly then, markets generally at the moment, yes, European equities are positive. Euro Stoxx 50 up around 0.5% after the cash market closed, gains of just 0.1% on Tuesday. Asian stocks generally higher. US futures in the green, though giving back some gains. But Oracle's surge to the upside after markets, after hours, really helping indices of sorts there, or sentiment at least. The stock, it was up last time I checked over 30% in the grey market. Essentially it missed Q1 expectations on EPS and revenues, but a key metric that showed a huge backlog of signed cloud deals, which are yet to be recognized as revenue. So watch out for Oracle on the open later. The dollar otherwise fairly flat, small bids to start the day, retracing some of those losses from yesterday. Stocks, as I mentioned, futures just positively in the green, and gold retracing some of those losses from yesterday. Actually, that pullback after hitting another fresh all-time high at 36.74. Okay, just on firstly Japan and some of the political issues around Japan. If I just pull up first of all a dollar yen chart, which you should see here. Yeah, so over the weekend we saw the resignation of the PM Ishiba, which added to sort of fears in the bond market about the prospect of looser fiscal policy emerging. For reference, Japan will now hold an LDP leadership campaign, leadership election, sorry, on the 4th of October. Here, one point of focus, of course, will be whether someone like Takaichi comes to power on a ticket of fiscal expansion, and that could possibly mean a slower normalization of monetary policy. Given FX markets now seem to be taking fiscal risks far more seriously in Japan, weekend developments, of course, saw dollar yen push higher. But then we've seen that on the chart here, the black line's a 200-day moving average, that capped the upside, and then we moved sharply lower actually yesterday before retracing a lot of those gains. Interesting price action after the announcements. As I say, the 200-day moving average, that's at 148.70, and then you've got the 50-day moving average at 147.49. The grey line is the 100-day moving average at 145.95. Interesting that yesterday then we got that sell-off in dollar yen, so yen strengthening on reports that the BOJ would actually look through this political noise, and that wouldn't prevent it from potentially hiking towards the end of the year. That saw dollar yen sell off, as I say, and it looked as though it was breaking down finally, but then we retraced a lot of those losses after actually the non-farm payroll BLS revisions, and we're trading back by the 50-day, around the 50-day moving average, as I said, at 147.49. So just watch out for Japan going forward and any political developments, and potentially who comes on the ticket and then who comes to lead the LDP going forward. This issue around expansionary fiscal stance is obviously what markets will be watching. That does need the cooperation of opposition parties, but yes, it's definitely something worth watching going forward for the yen. In France, moving on, we obviously had the PM Bayrou stepping down after the confidence vote overnight, and yesterday President Macron named Sébastien Lecornu, I think it is, as the new prime minister. He's basically seen as a loyalist to the president, but he was asked to hold talks with all political groups in parliament before announcing his new cabinet in order to try and find a compromise on a new budget. That sort of workable outcome, workable budget still looks very difficult, with those opposition parties very much not wanting that to happen. It kind of looks like it's a sort of kicking the can down the road, the political road, at least for the time being in France. Generally, that is kind of what happens, although I haven't used that phrase for a while in Europe, which we always used to use quite a lot of, kicking the can down the road, that is. Possibly it puts French risk premium spreads in a sort of hold at a high level sort of stance at the moment. Political uncertainty likely to persist. And most economists are not looking for, political uncertainty likely to persist. But that said, I think a lot of people, a lot of economists, not looking for sort of a Eurozone wide period of stress. That is the key takeaway, really. It's a domestic issue, and at the moment, not something that's going to affect the wider Eurozone. Italy and Spain, if you remember, they've been enjoying 7 sovereign upgrades recently. And the ECB, of course, has its instruments, the transmission protection instrument, I think in this case, the TPI, if things really get out of hand with French and German and other bond spreads widening a lot. As I say, a localized French issue then at the moment, although actually on Friday we probably will get a potential sovereign downgrade from Fitch for France, and that obviously won't help the mood, although most people are kind of expecting that on Friday. Okay, otherwise, moving on from those then, equities, they extended their grind higher yesterday. If I just pull up the chart. Bear with me 1 second. The S&P 500, which is here. Equities extending their grind higher yesterday. Kind of pain trade in some ways, you could call it. Basically an uncomfortable lift, really, where investors remain uneasy about valuations, of course, macro risks, yet the market keeps drifting up. So cyclicals, they outperform defensives, tech basically outperforming defensives, and volatility edged lower. Kind of a classic rally given where we are in the cycle and how positioning is. All 3 major US indices, so the S&P, the Dow and the Nasdaq, all made record closing highs, really underlining the strength of this move. On the one side, I guess you've got the wall of worry that remains intact, so sharp downward revisions to US jobs payrolls numbers, French government obviously losing that confidence vote, geopolitical tensions, of course, following the Israeli strike in Qatar, Yet, of course, the market has shrugged it off, really. Underlying data flow yesterday actually generally is pretty solid. Political, geopolitical noise, as well as I've mentioned, not really altering that sort of fundamental economic outlook. And then as well, on the positive side, stronger than expected corporate earnings going forward, resilient US GDP, of course, and then underlying this in a way, optimism around sort of AI-driven growth still remain all key bull drivers, if you like. So no sort of upsetting the bull trend, the risk rally really. Not much to say really. You've got the intraday high at 65.32 on the S&P. We closed at 65.12. You can see the 50-day moving average somewhat below that at 63.63. For the Nasdaq, similar picture really. Record high, as I say. We've got that uptrend line, and just below that, the blue line, the 50-day moving average, that's at 23.253. You've got the close at 23.839, and then that intraday high just below 24,000 there, 23.969. And then the Dow also made fresh highs, record highs, really looks primed for a move higher towards 46,000. That closed 45,711, and then the intraday high I think was yesterday as well at 45,764. Yes, no, it wasn't actually. The intraday high from last Friday, it's 45,770. But it does look primed. We're not overbought in any way, just bullish consolidation before then a bullish move higher. That looks like at the moment. Otherwise, support, decent support, looks like at the previous high from January at just above 45,000. Okay, moving on from stocks then and current themes to, yeah, just a quick look at last week's main events. Of course, non-farm payroll, the key one. We just got a few graphics and charts as well, just to help you with this review. The report ultimately soft, of course. The headline print at 22,000 from an upwardly revised 79,000, so well below the 75,000 forecast, and even beneath actually the lowest break-even estimate number at the Fed that they provided, in fact, which was sort of 30 to 80,000. And if you include revisions, then 3 of the last 4 prints, 3 of the last 4 months then have been below the break-even rate, with the June print, just to remind you, falling into negative territory. So that was the headline. The unemployment rate ticked up as expected, actually to 4.3%, driven by a growing labor force. The estimate, recent Fed estimates, was for a 4.5% UE rate at the end of this year, but that does get updated next week in the dot plot and new summary of economic projections. Average hourly earnings came in line as well, 0.3% year month on month, and year on year at 3.7%, down from 3.9%. I think it's interesting just to look at the details in some of this. We've been saying for some time now, actually, in fact, over the past 2 years or so, 90% of all jobs have come from just 3 sectors. That's government, private health, and in education and leisure and hospitality. If you strip those 3 sectors out, then payrolls have actually fallen for 4 consecutive months. And that does show the problems that the sectors typically associated as being kind of growth engines of the US economy, though does show the problems that they are facing. Those sectors being tech, being construction, manufacturing, and then services sectors as well, aside from those 3, and it just highlights really that we have job growth just in 3 main sectors. We also had a bunch of other data as well. Just before I get to that, non-farm payrolls, you can just see then that was the poll, 78,000, 75,000, and went down to actually the consensus just ahead of the non-farm payroll report last Friday, and we got a 22,000 print, that line pretty much. You can see that relative to what we've seen recently. And then unemployment rate, you can see ticked up to 4.3. Now we're closing in on that sort of 2021 high from the pandemic, which is at 4.5%. So interesting numbers. And as I say, last week as well, we did get a load of other jobs numbers as well. The JOLTS jobs vacancies falling below 1, actually, the ratio of vacancies to the number of unemployed Americans. That fell below 1, as I say, that ratio, and that's the first time since 2018, if you exclude the pandemic. The quits rate as well in the JOLTS numbers hit 2%, and that really does signal wage moderation. ADP now becoming a slightly more reliable gauge after basically the revisions we've seen in non-farm payrolls. So more attention being paid to the ADP number that halved in August, and then even Challenger numbers, they saw the weakest hiring for August on record, and the highest layoffs as well on record, excluding 2020. So yeah, not a great picture in the jobs market generally, and certainly non-farm payroll highlighted that as well. Data, as I said, if we just go back to that, sort of remains consistent with the view the job market is cooling, really, probably not collapsing, but just cooling. Obviously, people feel changes in the job market before they show up in the official data. We know if, of course, if your company has a hiring freeze or the odd person here or there is being laid off, this kind of suggests the real threat of outright falls in employment later this year. And again, we always say the US economy is dominated by consumer spending. That's 70% of GDP. The consumer is kind of, as we know, already feeling slightly anxious about tariffs, hiking prices, and that then leads to squeezed spending power. If we then overlay that with worries about jobs, then that kind of suggests downside risks for economic activity are picking up. Obviously, for the Fed, then we nailed on pretty much that 25 basis point rate cut, which is going to happen next week. Markets pretty much fully priced for that, and then they priced in around a 10-11% chance actually after the data of a 50 basis point cut next week. So sort of non-negligible, 1 in 10 chance really, and slightly that's moved down, I think, to around 8% now. But yes, still pricing in some sort of chance of a bigger cut next week. Otherwise, there's around 68, 70, 69, 70 basis points all in for this year. So just marginally under 3 cuts for every meeting in 2025. So September next week, end of October, and then middle of December, those 3 FOMC meetings with a high chance, yes, as I've said, of 3 25 basis point cuts at the moment being priced by markets for those 3 meetings. I should mention as well, we had those benchmark revisions by the BLS that happened yesterday. An interesting move actually, to kind of triggered a sort of buy the rumor, sell the fact reaction. Really, we had a downward revision. This was of the April 2024 to March 2025 payrolls growth. That was of 911,000. So that revision was bigger than the consensus expectations of around 700,000, a negative 700,000 revision. And all suggests really that the US economy was already in a weak spot sort of mid-2024. And even as the data don't give any concrete information on the actual development of the US economy kind of post-tariffs, it might still have supported the case for some faster Fed easing due to a weaker starting point. That said, I guess the data does show no sharp rise in layoffs or unemployment, but slowing job growth kind of reflects limited available workers. As I say, US yields in the first reaction briefly tried a test of the downside before then the market reversed that. Interesting, I think, and I just want to pull this chart up actually, the 2-year Treasury yield. We don't look at Treasury yields that much, but let me just pull this up quickly, which is here. So the 2-year Treasury yield, that dipped down, but then found some buyers, well, some sellers in the bond, yields pushed higher. But we are around that. You can see it's found support, the 2-year, which highly correlates with Fed funds futures, so Fed funds rates essentially. We did find support at the spike low from the Liberation Day spike low that you can see here. So interesting that we found support. Whether we do find that support going forward, 3.5% for the 2-year, will be interesting, as I say, going forward. The more widely watched, in a way, a sort of 10-year US Treasury yield, that's sort of a benchmark for global borrowing costs. You can see we haven't got close to that spike low yet, which was below 3.9%. We were closing in on 4%, but haven't quite reached that yet. I'm just pulling this back to this move of those lows from last year in September, and then the highs in January. We're on the sort of 61.8 retrace, just around 4.06, and have found some support there. So as I say, this is a sort of proxy for global borrowing costs, so just watch out for that as well. Okay, otherwise we did have ISM data out of the US. Manufacturing, that was better than expected, and then services as well, better than expected, all really highlighting resilient growth in both the services sector and a pickup and improvement in conditions in manufacturing, actually. So just touching upon that briefly. Otherwise, just again, we'll touch upon this in the ECB meeting preview, actually. Eurozone inflation, that came out a touch higher, actually 2.1%, the headline, above the 2% in July. Core at 2.3, above expectations at 2.2. Actually marks the 4th consecutive month that inflation has aligned with the ECB's target, though. Monthly trends remain consistent with what we've seen in the past few months. So services inflation, that remains slightly elevated at around 3%, but then energy prices have declined, good prices increasing, but remain minimal. Most economists expect inflation to average 2.1% in Q4, and then that then falls below target towards 1.8% in 2026. Okay, let's move on then to this week's main events. Just pull up, this week's main events, which come out on Thursday, CPI data, and then the ECB meeting. Just a chart here of what's happening with US CPI. That black line is the headline number, and then the red line is the Fed funds rate, and of course that dotted line is the 2% Fed's inflation target. So just above that at the moment. Expectations are for consensus to rise by 0.3% month on month versus the previous 0.2%, and that would be 2.9% year on year. While the core is seen rising 0.3% in line with the previous month-on-month reading, and 3.1% year on year. Of course, this is the last main data point ahead of next week's Fed meeting on the 17th. Markets, of course, will be watching the data for signs of any further tariff pass-through, which could become more evident, of course, in these coming months as firms basically increase imports amid their falling inventories. There's likely to be more evidence of good price inflation being triggered by tariffs, but remember that core goods, which are the items most vulnerable to tariff impact, are only 19% by weight of the inflation basket. So remember that, because otherwise housing costs, which are a third of the basket by weight, 33% or so, they're likely to be show more evidence of softening rents, and that's based on Zillow data and also the Cleveland Fed's measure of new tenant rents and existing rents. So essentially any tariff impact in core goods, any pickup in that may be offset, we're saying, by housing costs, which have this bigger weight. Energy prices as well, they're also falling, while we aren't seeing the same sort of wage pressures that's contributed to this pickup to 9%, of course, in 2022. Wage pressures, if anything, moderating, given, as I said, those quits rates in the jobs vacancy data, which is not a bad lead indicator of earnings going forward. bottom line really is that a 0.3 month-on-month increase in the core and the headline really will not be a barrier to that rate cut next week, given evidence, of course, of cooling activity and this stalling jobs market, which apparently, seemingly now, the Fed Chair Powell and the Fed officials are looking at more closely than price stability. So yes, there's more concentration on the dual mandate around maximum employment as opposed to price stability and inflation. Not saying that, so obviously we would probably need a really big print to upset those odds of that sort of pretty much nailed on rate cut next week. So yeah, just watching out for US CPI going forward. This afternoon we do get PPI data actually as well. That could attract more attention than usual because it's released ahead of the CPI data, which is quite rare actually, and also because the previous July PPI release surprised significantly to the upside. It will provide markets with the first sense of how tariff-related costs have continued to build, and the numbers, well, final demand PPI is expected 0.3% month-on-month, 3.3% year-on-year. If we, just before we go to the ECB, actually, just let's pull up the DXY chart first of all. Which is here. So you can just see we're hovering around still. The blue line, the 50-day moving average, is kind of a pivot point at the moment. Can't quite break fully to the upside or the downside. That's a 98.10. You've also got the 100-day moving average capping that upside actually at 98.63. And then above that, you've got these swing highs from end of July, start of August, plus a previous swing low from 2023. Plus a fib level as well, all around sort of 99.60 or so, that area and just above. So strong resistance there, as well as initial resistance at that 100-day moving average. Then below, you've got swing lows from late July around 97.10, and then the longer term low, multi-year low actually at 96.37. Just that thick dotted line, just for your guide, is a very long-term uptrend from 2010 here and also 2021, and I kept it in there because obviously it capped the downside previously in the start of July with that print at 96.37. So you'd expect that to be very strong support. Okay, that's the DXY and the inflation data this week, with PPI today, CPI tomorrow. Otherwise, we do get the ECB meeting as well. So let me just pull up the graphic from there, which I showed you briefly, which is here, of course. Yeah, the bank expected to hold rates at 2%. And as a reminder, well, the July meeting saw, again, the ECB stand pat on rates, with President Lagarde reiterating that policy remains in a good place, suggesting officials not in a rush to adjust policy, likely to see those words possibly again. Yes, Lagarde confirming that. Since the July meeting, well, we've had the EU and the US formalize their trade agreements, which saw EU goods, of course, subject to a 15% tariff versus the initially threatened 30%. And then on the data side, well, Q2 growth has been resilient in the face of those trade tensions. Composite PMI data has moved further into expansionary territory, with the pace of expansion actually ticking up to a one-year high. And then, well, the inflation front we've mentioned already did rise a touch, but nothing really to cause any concern for policymakers to cut at this meeting. So standing pat, as we say, moving forward. Clearly, there is still a split actually on the governing council between the doves, flagging the likelihood of greater downside risks to inflation, and the hawks as well on the other side, being of the view that the rates are already mildly accommodative, and they do not see a reason for further rate cuts going forward. Yes, so that's ECB market pricing. You can see here then the bank markets expect the bank to remain on hold this year, and there's less than a 50% chance, I think, of a rate cut by March next year. So nothing fully priced, and you can see that on this red line, and even slightly more hawkish than that the blue line, which was at the last meeting. But pretty much, yeah, unchanged for the duration of this year and potentially next year as well. If anything, then, given the lack of fireworks from the statement potentially, then there may be more emphasis on and focus on the accompanying staff fresh macro projections, and also then a focus on the 2026 inflation forecast that's expected to come in at well, materially below the bank's 2% target of 1.6%, but consensus on those projections looking for an upgrade to that view, possibly to up to sort of 1.8, 1.9%, with growth held pretty steady around 1.1%. Aside from that, then, the press conference, always interesting. President Lagarde likely to be asked about any potential backstops for French debt, of course, and then also potentially may be asked about the deterioration in the US Fed independence and potentially what that means for the Eurozone economy. So watch out for that. Let's just get to euro dollar then. And the chart, which is here. So you can see the blue line again, just trying to push up above that and struggling to do that decisively. That's a 50-day moving average of 116.59. We've got that long-term high at 118.30 from back at the start of July. So not much to say, really. The more we track sideways, we're thinking with this breakout last Friday, push higher, then that would have been a decent break higher, and especially then the follow through on Monday. But then we've seen it turn back towards this 50-day moving average. So yeah, just undecided at the moment, euro dollar, with yes, potentially, possibly, if we get a more hawkish than expected Lagarde, then contrasting with, of course, the Fed cutting, that may be the boost the bulls need. Otherwise, if she's more cautious, then obviously we then probably pull back towards that 116.59 area and possibly below, that being the 50-day moving average. Otherwise, I can touch upon actually UK GDP data we get out on Friday, and I'll pull up the cable chart as well, actually. Yeah, growth is expected to print 0.3 low at 0.1% in July. That would see the Q2 reading at 0.3%, so lower somewhat than the pace in Q1 of 0.7%. That was pretty much boosted by government consumption. Just to remind you, I think most economists reckon Q3 could remain actually surprisingly solid with good weather helping. We've had politics as well rear its head actually in the UK. Of course, last week we had a cabinet reshuffle by PM Starmer because of the resignation of the Deputy Prime Minister, but it didn't touch the Chancellor, Rachel Reeves, who is actually valued for her market credibility. Let's not forget that. Gilts, of course, they remain the weak link for sterling, potentially in the build-up to the autumn budget, which is will potentially become quite noisy around, yeah, gilts and any rumours of what will happen in that budget. Of course, we do get Bank of England meeting next week, and news on quantitative tightening plans will probably be far more interesting because nothing is priced in for that meeting, and essentially is actually underpinning support for sterling, certainly against the dollar, because no rate cuts are seen, certainly for the Bank of England this year, actually contrasting again with the Fed and the dollar. Cable, then you can just see there's a sort of barrier around 136, resistance therefore, and then supports, well, you've got the 100-day and the 50-day coalescing around sort of 134.60, 64 area. We've still got in a high from September of last year. That's at 134.34, and then you've got the first fib level of this move higher at 133.86. Okay, we'll wrap it up there. Thank you so much for being with us for the 35 minutes or so. Do appreciate you being on the call, and we will speak to you in a couple of weeks, which will, of course, entail the Fed meeting and the Bank of England meeting, which take place next week. So good luck out there. Just touching on that Fed meeting briefly, quite an important moment really, because it will resume the easing cycle. I've sort of mentioned what is expected for the next few meetings. The shift really, as I said, goes back to the employment side of the mandate, really on the belief that tariff-induced price hikes won't pose a risk to price stability over the medium term. Yeah, that's kind of the Fed meeting really. We do get updated dot plots and summary of economic projections really. So those will be of interest to see what officials think going forward. We do get 2 years, 3 years ahead actually, I think, as well in this meeting. But again, I always stress that a lot of the dot plot and the projections are taken with a pinch of salt by most economists. And we only sort of look 6 months, 9 months out at best, because I think it's generally recognized those projections aren't really that reliable after that sort of time period. So much to look forward to there, and we will speak to you in a couple of weeks. Take care.